You know that feeling when you check your portfolio and a stock is down sharply, maybe 10%, maybe more. That instant drop in your stomach is a very real reaction, and almost every investor experiences it. The first step to staying calm during a drop is to understand what's actually happening. A falling stock price doesn't automatically mean the company is suddenly worth less or that your investment thesis is broken. Market prices fluctuate constantly, sometimes because of earnings, sometimes due to macroeconomic news, and sometimes simply because other investors are reacting emotionally. When that happens, remind yourself that price and value are not the same. Price reflects what people are willing to pay in that moment. Value is determined by the company's fundamentals, its business, cash flow, leadership, and future prospects. Those fundamentals rarely change overnight. It also helps to literally zoom out. When you look at a one-day chart, even a small move can feel like a crisis. But when you switch to a 1-year or 5-year chart, those short-term swings often disappear into the bigger picture. A 10% drop might feel catastrophic in the moment, but in a long-term trend, it's often just a temporary dip. Volatility is a normal part of investing. Every long-term investor has experienced significant drawdowns, sometimes more than once. These periods are not an exception to the rule. They are part of the process. Long-term returns come from being able to manage your reaction to those fluctuations. Another important concept is unrealized versus realized losses. A decline in price doesn't equal a loss unless you sell. If your reasons for owning the stock are based on solid research and nothing fundamental has changed, then a temporary drop in price does not automatically require action. It simply reflects what's happening in the market at that moment. Having a clear investment plan can also make these situations less stressful. If you know why you bought the stock, what would make you exit, and what your time horizon is, then you remove a lot of uncertainty from the decision-making process. That clarity allows you to rely on your strategy rather than reacting emotionally to price movements. Sometimes the most rational response is to do nothing. Market noise can be loud and overwhelming, but not every move requires an immediate reaction. Taking a step back, giving the market time to settle, or simply letting your plan work can often be the best decision. Finally, remember that almost every strong company has gone through sharp corrections at some point. Short-term drops are common, even in stocks that have grown tremendously over time. What separates successful investors from emotional traders is the ability to recognize the difference between a temporary price fluctuation and a true change in fundamentals. And in the end, that's what matters most, keeping your emotions from making the decisions your strategy should be making. Markets will always move up and down. What determines your long-term results isn't the size of the drop, but how well you can stay steady through it.